because by selling 25%, I recouped all the capital that I had invested in the sector and paid the capital gains tax on the sale.
Hmm.
In other words, I sold off 25% of my upside a quarter, and I eliminated my downside. The wins have to amortize the losers. And you can't be playing a speculative game, a real speculative game, for a double or a triple. That can be your interim goal. At a double or a triple, you take enough money off the table that you've de-risked the rest. I get that part.
Hmm.
Uh, what I like about the oil business is that it's fundamentally mispriced. Uh, there's a lot of price elasticity or demand inelasticity. So the gross arithmetic is I have five starts. I have let's be conservative and say 25% chance of success on any start,
Hmm.
which means statistically over five starts, I likely have one success. Mispricing that occurs because of illiquidity and a real anomalous difference.
Rick Rule, good afternoon to you, my friend. It's really good to see you. It's been a little while. How are you?
My pleasure, Andy. Thank you for having me back.
No, anytime, anytime. So we're in mid-February here, but I couldn't get you earlier because you are in high demand. But I wanted to talk about just set this up with what are if you do you have any things or what are your expectations for 26 if you have any expectations, and I'll share mine.
Well, I'll tell you, I thought 25 was going to be a pretty good year. Boy, was I wrong. It was a spectacular year.
Right?
And I think part of the performance that I would have expected to enjoy in 26, I enjoyed in 25.
Hmm.
Which is to say, I think for the next 10 years, that precious metals and natural resource markets will do well. But I think some of the performance that we would have expected in a normal year was already used up by an extraordinary year. I think we will see, for better or for worse, a lot of volatility. I know that the precipitous decline that we saw February 1st in silver unnerved a lot of folks. I've been in the silver market for 50 years, so it neither unnerved nor surprised me. But we'll see more of that. But I think your listeners need to come into 2026 understanding that the move that occurred in part of 2024 and 2025 was really reducing tension on a coiled spring. In other words, some of the move that we enjoyed in 2025 was a delayed move from prices that didn't move in 20, 21, 22, 23, 24.
Okay.
That that latent energy has been used up. So don't look for 26 to repeat 25. Look for it to be a good year, but not a great year. Think of it in the context of what has to happen over 10 years and accustom yourself to the fact that the market could be up 20% in a month and then give back that 20% over a long weekend. The one thing I'm certain about for 26 is that we will experience breathtaking volatility. If you're prepared for that volatility, both psychologically and financially, you'll do fine.
Yeah.
If you weren't, you'll be shaken out for no reason.
Rick Rule's opening framing is the antidote to every breathless precious metals prediction circulating right now. He is not saying the sector is done. He is saying the easy money was made in 2025 when the coiled spring released. The next leg higher will require patience, conviction, and the psychological ability to watch positions drop 20 to 30% without panic selling. The 10-year framework is crucial. Investors who are asking, is this a good entry point in February 2026, are asking the wrong question. The right question is, do the fundamentals support owning this asset for the next decade? If yes, short-term volatility is irrelevant. If you're not sure, you haven't done enough work to own it in the first place.
Yeah. About that, so you might have used the same saying, and I use it all the time, and our friend Doug Casey's used it. Volatility is your friend.
It
Embrace
can be.
volatility. It can
It
be.
can be.
It
Yep.
can be.
Yep.
Work that out a little bit more for me in regards to being disciplined in portfolio management. And I say that to give all viewers and listeners, this is not a pat on the back because, as Rick just alluded, I was early to this move and I did great in 25, but I was early to that move and I took my lumps before then. So just full disclosure. But I was started taking profits in fall 25, and it was just really just for anything else, just an exercise in discipline. I just had to take money off the table. Comment about that and the importance of that. Again, that's using volatility as your friend.
Well, that's correct. We, in October of 25, had a day that had it occurred in commodities would have been lock limit up.
Mhm.
There was no ask in the junior equities markets. There were all bids. I've learned in my life that you do whatever the market makes really, truly easy. If there's
Mhm.
no asks, you serve the market and throw up an ask.
Mhm.
If there's no bid, you serve the market and throw up a bid. So I, like you, in late 2025, August to be specific, I sold 25% of my junior stock portfolio.
Mhm.
I did it because by selling 25%, I recouped all the capital that I had invested in the sector and paid the capital gains tax on the sale.
Mhm.
In other words, I sold off 25% of my upside a quarter and I eliminated my downside. That's a pretty good print. Now, I had what I guess was an unusually good collection of stocks because the remaining 75% has now attained the value that it was before the sale. Do I feel bad about the sale because of the money left on the table? Not a bit.
Mhm.
Not a bit. Volatility works both ways.
Right.
What you learn if you've been in markets as long as I is that when a stock chart goes parabolic, what the Canadians call a hockey stick chart, where it goes straight up, it's going to go straight down for a while after
Mhm.
that. The back side of the stick is just as steep as the front side, but if you're long, it's a lot less fun. So, from my viewpoint, whenever I see a parabolic upside, assuming that nothing else has changed, I sell.
This is the single most practically actionable segment in the entire interview. Rick Rule is describing a portfolio management technique that most retail investors never execute because it feels psychologically wrong, selling into strength. When there are no asks in a market, most investors feel like geniuses holding. Rick uses that moment as a signal to serve the market and sell. The math is beautiful in its simplicity. Sell 25% at the top, recoup your entire initial investment plus taxes, then watch the remaining 75% with zero downside risk. You have literally turned a speculative position into a free ride. The fact that his remaining 75% recovered to pre-sale values means the cost of this insurance was zero in retrospect. But that is not the point. The point is it eliminated the possibility of a catastrophic outcome.
Mhm.
Similarly, when I see a day like we had not too long ago, where it's a parabolic downside, you might buy.
Mhm.
I'd like, as an example, right now to increase uh, fairly substantially my oil and gas portfolio. But the oil and gas stocks are trading up. They're trading up because of news in Iran. They're trading up because of Venezuela. They're trading up because of Trump's alleged, allegedly tougher Russian sanctions. And so I'd like the market to cool off. I'd like the oil quote, which is now priced up to, spiked up to 66. I'd like it back around 53, 54. And it wouldn't surprise me if I got it. I'd like to greatly increase my position in Schlumberger. Schlumberger is on fire, which is
Mhm.
not what you want if you're a buyer. It's what you want if you're a seller. So I'm praying for a little negative volatility in the oil price.
So I was going to go there later, but let's go there now because we also talked about diversifying our portfolio. And I paraphrase, I want to make sure I get this right. You said at the time the oil and gas market was similar to the gold market X amount of years ago, and that could have
Yep.
it was just a few years ago. And I was already nibbling in some of my favorite names before then. And then I went a little bit bigger, but I still haven't. I still don't have enough.
Right.
And this move has scared me, not scared me in the sense that I'm right, but I'm like you, man. I like to buy stuff at a bargain. I like
Yep.
pain. I want pain. So work
Well,
that.
I was able for the last 2 years, until very recently, to buy Exxon.
Right?
I think I said in an interview with you, Exxon at $100 is a gift. Well, that's
Yeah.
fine, but it's at 160. you know.
Right?
So that's dated.
I
And you
told my
know,
mother who watched that interview, she go, what do I buy? I go, honey, mom, just buy Exxon. And
yeah,
I'll send this to her. So then she
yeah,
did.
and you know, Exxon at 100 is not the same as Exxon at 160. But
Right.
because I already have a big position in Exxon, I don't have to buy it.
Right.
Make no mistake, I think over 5 years it's going much higher.
Hmm.
And if you and I interview in 5 years, if I'm still alive, we'll probably look back at this and say, why were we price sensitive? It didn't matter. But right now it matters. Right?
Right.
Now
Well, that's the thing. Yeah, it matters
I
right
need
now.
to
Go ahead.
I need to say something else, Andy.
Please.
I bought well, that's not true. I put in bids on 5 oil and gas juniors yesterday. I was underinvested in the speculative part of my oil and gas because I said to you, uh, the big guys are so cheap, I don't need to speculate. I get a good enough move out of beta. I don't need to chase alpha.
Right.
But there's a subsector of oil and gas juniors, people that aren't in the United States and Canada. They're in countries that people hate, and they aren't in shale. They're in conventional offshore exploration. And those stocks haven't moved at all. There are some seismically supported plays that I think have wonderful risk reward parameters, provided that you understand that they're risky.
Hmm.
And I'm not going to give you the names because I'm not Phil yet.
Yeah.
But let me tell you what they share in common.
Yeah.
Each one is exploring for what could be a very large discovery. And each of them are well seismically supported, and they have producing analogs in the same basin,
Hmm.
which is to say there's good exploration science. They are well enough seismically supported that the industry would tell you that each discovery hole stands between a 25 and a 35% chance of success. Turning that the other way around, there's a one chance, pardon me, there's three chances in four that you fail,
Right.
or two chances in three that you fail. In other words, the probability is failure.
Hmm.
Because they're public, in other words, because I'm not drilling a well with my own money, where if it dry holes, it goes to zero. The likelihood is that on an unsuccessful effort, I lose 35 to 50% of my money
Hmm.
on any unsuccessful effort. By spreading my risks over 5 bets, the upside is if I hit, I get 15 or 20 to 1. So the gross arithmetic is I have 5 starts. I have let's be conservative and say 25% chance of success on any start,
Hmm.
which means statistically over 5 starts, I likely have one success.
Right.
On my 4 fails, I lose 35% each on 4 starts. And on my hit, I get 15 to 1.
Yeah.
That's pretty
The,
good math.
the math works.
That's pretty
Really,
good
really well.
math. What I like about it is there's no premium, there's no success premium.
Hmm.
These little penny dreadful silver mining stocks, somebody right now gets some surface samples, particularly if they get the surface samples in British Columbia or Colorado in the United States. The surface sample gives them a $15 million valuation, which is to say there's an incredible premium built in for the expectation of success.
Hmm.
In these little offshore juniors, because they're in countries that many people can't pronounce, uh, offshore exploration is unloved. These countries are unloved, and oil and gas is mostly unloved.
Hmm.
So there's a situation where I couldn't help myself. I had to take this exploration shot.
Okay, so I want to work a lot about that because I love the risk assessment. It's almost
Right.
gaming in the sense of just playing probabilities, right?
Right.
You're playing probabilities. But what's also, I think, key most people lose is that you're going for a big asset.
If you're, I can't emphasize this to your listeners enough. If
Hmm.
you're taking the risk inherent in exploration, which whether you admit it to yourself or not, has the probability of failure. In other words, is more likely that you lose money than you don't. The wins have to amortize the losers. And you can't be playing a speculative game, a real speculative game, for a double or a triple. That can be your interim goal. At a double or
Mhm.
a triple, you take enough money off the table that you've de-risked the rest. I get that part.
Mhm.
But you have to be playing the game for a 10 bagger. Or else, arithmetically, you're not speculating, you're losing. There are a lot of people for whom a win is psychological, which is to say, they take a risk of a wipeout, they make 30% on a trade, and they go home happy.
Mhm.
Those people are dumb because the expectation over 10 starts is that you have six or seven losers. If you make 30% on two and you lose 25% on eight, guess what? You might feel good about the two, but you've done yourself an enormous disservice financially.
Mhm.
In exploration, the size of the prize, the probability of success, and the cost of the test are the questions you have to ask yourself.
This is the most important conceptual framework in the entire interview for anyone who owns or is considering owning junior exploration stocks. The math is brutally simple and almost universally ignored. If your probability of failure is 65 to 75% and your losses on failure are 35 to 50%, then you need wins that are not 2x or 3x. You need wins that are 15x or 20x just to come out ahead. Most retail investors in junior mining accept this risk profile while aiming for returns that don't compensate them for it. They are losing money with mathematical certainty over a long enough sample size. Rick's solution: 5 bets, unloved jurisdictions, 0 premium, large prize, seismic support, is the framework that actually makes the math work in your favor. The comparison to BC silver surface sample stocks with a $15 million premium built in is devastating. You're paying for success probability that hasn't materialized yet.
Okay, so another thing is that you mentioned because I have all US and Canadian drillers, as I call them,
Yep.
and producers. I'm interested in other jurisdictions, but what I guess my question would be, how do you determine value in these other jurisdictions? And that's what I'm afraid of. I have to be it has to be stupid cheap for me to go into some of these places, right?
Well, I would sort of agree with you.
Uh,
Uh, but I have to say, my worst experience with political risk was in the People's Republic of California.
yeah, right.
I'm not trying to say that Guyana is good or Namibia is good. I'm trying to say the United States is bad too.
Yeah.
It's predictably bad, which is good. What we do have in the United States mostly is the rule of law. Some parts of the United States, like California, they aren't paying attention to the rule of law, but it exists.
Mhm.
Um, there's predictability, but you have to look at the other jurisdictions on a case by case basis. What's the fiscal regime like? Can you get a fiscal stability agreement?
Mhm.
A lot of these countries, uh, they're real cool with you fiscally until you make a discovery. And then when they see that there's $3 or $4 billion to steal, they change the terms
They
after the
take it.
fact.
Yeah.
But if you have a fiscal stability agreement before you drill the well, where they're bound by that agreement for 20 years and where it's arbitrated in Stockholm or Geneva, that's a better circumstance.
Mhm.
In some cases, a much better circumstance. So you have to do it on a case by case basis. When I see smarter, more sophisticated players than let's say I see Exxon in a basin, Chevron in a basin, Total in a basin, uh, I feel better about that basin when the concession that I'm drilling or that I'm even just shooting seismic on has a fiscal stability agreement in place with a host government where they can't change the terms on me after discovery. I can afford to be more generous.
Mhm.
The difficulty I have, well, difficulty, I guess the advantage I have is I'm competing with speculators who don't know what a fiscal stability agreement is,
Mhm.
much less are willing to take the time to figure out if there is one. So to come down to the five stocks that I bid on yesterday, they were narrowed down from a list of 31 stocks that I spent, I don't know, 3 or 4 months pawing through data about.
And what was it then that made you pull the trigger on the bid or hit the bid?
Um, Really the seismic, uh, the probability of success. Now, the other thing was that each one of these five companies has somebody who I've done successful business with in the past.
So you knew them.
Well, I knew some people in the company.
Right.
If it wasn't the CEO, it was the chairman, it was a director, it was the largest shareholder. I knew the reasons, if any, why the stocks were cheap.
Rick's California political risk example is the perfect rhetorical move to reframe the entire conversation about emerging market investing. Every investor viscerally understands that California regulation is hostile to resource development. Once you accept that California is a legitimate political risk, it becomes much easier to evaluate African or Latin American jurisdictions on their actual merits, rather than dismissing them reflexively. The Fiscal Stability Agreement framework is the specific tool that separates Rick's due diligence from a retail investor's Google search. And the 31-to-5 research process, 3 to 4 months of analysis to place 5 bids, is the competitive moat that most retail investors are unwilling to build. Rick wins because his competition.
Yeah.
One of them is preparing to go into a truly foul jurisdiction. And they're going into a foul jurisdiction in an asset that I used to own part of before it was nationalized. And I really like the asset.
I know what you're talking about.
I really
So
like the asset.
I
So
think I know what you're talking about.
yeah,
Um, okay, so that's a great segue because you have a conference coming up, and I'm glad you said what you just said because my experience has only been 2 years now, just
right.
so everybody knows. I've had great experiences both years. Shout out to your staff, by the way, Callie and Barb, Michelle,
Yeah.
fantastic people. But really, there's two of my best. This is what is just added to my experience. Number one is great companies. I got to know the companies, and I'll shout out all five. Two, the first three I met in 24, and the next two I met in 25. I made money. I think those are the only ones I invested in. And there are a lot of great companies,
Right.
everybody. There are a lot of great companies. But the first year is Integra, did very well. Luca Mining
Right.
did fantastic. And
Right.
Contango Ore, which I did reasonably well, and I still own all three. Last year was the Cora Resources, which is now a Cora Royalties. Great, great model. And they're hitting it out of the park. And then Revival Gold, which I made money on, and I think is going to hit it out of the park this year.
Yeah.
I got to know the CEOs there. And you just mentioned that, hey, I knew people in the company, and that's what I did at your conference. So I don't want to say it was life changing for me, but it was certainly, or even portfolio changing. But yeah, it was portfolio changing for me. So thank you for that.
Well, thank you. You get out of my conference what you put into it.
Right.
If you come there, I'm not saying you shouldn't go on the boat cruise, but if you come just to go on the boat cruise, you can go on a boat cruise anytime.
Right.
What's lovely about this conference is that you can, and not just you, but your listeners can walk up to the CEO, and they will talk. If you listen to my pre-conference interviews, which you should, I interview every CEO of every exhibitor before the conference, so that listeners can utilize their time at the conference more efficiently. But at the end of every CEO interview, I ask specifically, who at the company can my attendees learn more about the company from? The right answer is when the CEO says, me. The
Mhm.
buck stops with me. Most of my CEOs will say, here's my email address, but if you want, here's my cell phone.
Mhm.
George Salamis at Integra
Yeah.
says the best place to learn about Integra is by calling me. I'm the CEO, I'm the largest shareholder. Here's my cell phone number.
Yeah. Right. On that note, I was walking the halls and I ran into Rob McEwen and I ran into
Right.
Frank Gusta, and they
Yep.
gave me their cell phone numbers,
Right.
these titans in the industry. And that was the second big value that I got, was just walking the halls and networking and meeting people. So
It's important that your listeners know that. Your listeners, who many of whom have talked to me because they've submitted portfolios to me, commonly say, well, Rick, you have access to all these people. right? Rob McEwen won't talk to me. Wrong. A good entrepreneur is so excited about what he or she is doing that they can't wait to talk to you.
Yeah.
They don't want to talk to you about the Super Bowl. They don't give a damn about the halftime act. That's nothing that matters to them. They don't want to talk to you about golf. Many of them don't even want to talk to you about their grandchildren. They want to talk to you about their company. And
Hmm.
somebody who isn't that involved, isn't that fanatic, is telling you something too. It means they don't have the drive to make it.
The oil thesis is the second most important segment in this interview, and the most underappreciated opportunity Rick is describing. The arithmetic is identical to what happened post-COVID, but on a longer timeline. When the lifting cost narrative misleads investors into thinking oil companies are profitable at $60, they ignore the sustaining capital deficit that is silently accumulating. Harold Hamm, cutting from 18 rigs to 0 in the Williston Basin, is not a minor footnote. It is one of the most experienced oilmen in America saying this basin cannot be economically developed at current prices. When that happens across hundreds of basins simultaneously, production declines are mathematically inevitable. And production declines at the scale Rick is describing don't resolve in months. They take years to reverse.
Yeah. Couldn't agree more. So I'll put a link in the show notes to your conference. Rick, when is it? Where is it at? But I'll put a link
July
in all the
6th through
shows.
10, Boca Raton, Florida, the Boca Resort. For those of you who don't know it, 180 acres in downtown Boca, half a mile of Atlantic Ocean waterfront, a palace. Lots to do there, separate and apart from learning, but I encourage you to spend most of your time on learning. If you can't make it to Boca, and by the way, we're going to sell out of physical seats within 30 days.
Yeah.
If you can't make it physically, which I would prefer, uh, you can join 3,000 people in 33 countries online, live stream. However you join, live or live stream, you'll have access to the recordings and you'll need them. We're going to give you 46 hours of material, some of which occurs concurrently over 4 days. There's no way you can take it in. You cannot take it in. I put on the conference, I select the speakers, I select the exhibitors, and I still have to play the tapes.
Mhm.
So to get your money's worth, it isn't 4 days of your life, it's at least eight. 4 days live, and then 4 more days reviewing the tapes. And by the way, listen to the interviews before the conference. Come to the conference fully armed. I interview the exhibitors. I interview the speakers. If you pay attention ahead of time to what matters to you, you can use your time at the conference more efficiently.
100%. Just my own strategy. What I did is I just made a list of companies, just put a list, and I started doing my own due diligence before I got there. And then I targeted them, who I was going to talk to and who was I going to put my money in. And then I whittled it down there more. So that's what I did. So,
Yeah. And I
um,
had occasion, admittedly, it's my conference. I had occasion last year. I got up early, went down to breakfast. There's Amar Al-Jindi, CEO of Agnico Eagle, sitting by himself.
think about
You know,
that.
may I join you? Of course.
Yeah.
It's wonderful.
Yeah. To a lesser note, my wife and I were just standing at a table. This was in 24, just by ourselves talking. And Empress Royalty came up to us,
Yeah, yeah,
Alexandra,
yeah.
and I didn't buy them. I should have, but they just came
She's a
by and just started
superstar.
talking. And
Yeah,
boy, did they do well since that
yeah,
time.
yeah. She's a superstar.
She is. She is a superstar. But hey, so I want to pull on this string a little bit more about oil here. So I think this is my thesis. I think why it exploded. And by the way, to all my viewers and listeners, we're putting a link to all of that in the show notes. You'll have access to it. You need to get on that soon because I'm not surprised, but to my disappointment, I say that the boat cruise is already sold out. And this is going to sell out. So you're going to have to act quick. Just to everybody that wants to go, don't put it off. Act quick. Links in the show notes. So I really have this thesis, Rick, and this goes back to my portfolio management days. And it's just about capital rotation, right? And capital flow. And I want to know what you think. I think I know what you think, but I don't want to speak for you. I want you to speak. So I think there's so much money made in gold. I'm a gold bull to everybody. I have a lot of gold stock, but I think we're taking a break here for the first half of the year. That's just excess got to be worked out. I think, and that's what we saw in January, a lot of this money is rotating into energy, oil and nat gas, but specifically oil. That's why I started buying is strategically last oil assets last November, December-ish. I wish I bought more. I'm waiting for it to come down. Come to me, come to me. But that's my thesis. I think oil is going to have a banger in 26 and really for a while. We're still in the early innings of that. But wanted to know what your thoughts were on capital rotation and just work out the oil thesis for me.
I kind of don't do capital rotation myself. I take advantage of other people's capital rotation when they're wrong. I agree with you that gold gave us too much last year.
Mhm.
I think gold trades a lot higher over 10 years.
Right,
But I think the tensions come out of that coiled spring that we talked about earlier in the interview. So
right.
I wouldn't look for a repeat of 25 and 26.
Sure.
I would look for a lot of volatility, as we said earlier, and I think that's a good thing.
Hmm.
I think in the very, very near term, oil's ahead of itself too.
Hmm.
Trading up from 52 to 65 uh, in the context of the Iran conflict in Venezuela. That's a news trade, and guys who trade news usually lose.
Hmm.
Uh, what I like about the oil business is that it's fundamentally mispriced. Uh, there's a lot of price elasticity or demand inelasticity.
Hmm.
I don't know what you pay in your state for gasoline. Let's say it's $3 a gallon. You might not want to, but you would pay six. If your choice is six or your car doesn't start, you're going to pay the six.
Hmm.
So there's a lot of room for the price to rise. And the industry is underinvesting in sustaining capital expense between $1 and $2 billion a day. Now, that doesn't impact them in terms of their production in 26 or maybe
Hmm.
27.
Hmm.
But 28, 29, it starts to bite.
Yeah.
2 years ago, I could say that this deferred sustaining capital investments was happening among big companies who were returning capital to shareholders, and it was happening in state-owned firms who were diverting free cash flow to politically expedient domestic spending programs.
Hmm.
Now, uh, like Continental Resources, Ham, he has taken his rig count in the Williston Basin down from 18 rigs to none.
Jeez.
What he said is that basin doesn't support drilling at $60 oil.
Think
The
about
truth
that.
is, uh, people, when they look at the oil business, they confuse the capital structure. They look
Hmm.
at the lifting cost of oil, which might be 15, $18 a barrel, and they say, well, these guys are making a shitload of money at 60. That's
Hmm.
wrong. That doesn't include amortization and depreciation.
Yep.
It doesn't include cost of capital, and it
Hmm.
doesn't include tax.
Yeah.
The fully loaded cost to produce a barrel of oil worldwide, if you include Pemex, National Iranian Oil Company, PDVSA, is
Hmm.
closer to $60 a barrel. If you add back theft, which is what I call tax and royalties, and cost of capital. So you make the stuff for 60, you sell it for 52, lose $8 a barrel, you do it 102 times a day, it gets unpleasant.
Yeah.
So unpleasant that, as I say, the industry is underinvesting substantially. As an investor, what you need to do is understanding that you need to segregate in your investments companies that are making the sustaining capital investments.
Hmm.
Ironically, the people who are cannibalizing themselves, who aren't making the sustaining capital investments, are paying high dividends and getting share buybacks.
Hmm.
So the companies who are making the wrong decisions are being rewarded in the market. And I particularly like that. Uh,
Right.
I particularly like it when my competition, who is often smarter than I, is doing the wrong things for the wrong reason. And you're seeing that happen in spades in the oil and gas business today, just in spades.
Okay, so what you all said, I just have several questions. I'm going to rapid fire here, just for sake of time. Um, you just said the oil market is mispriced. So then that begs the question, and I think I know what you'll say because you're a libertarian.
Right.
What is the right price? And
Well,
then,
near term, I think the price comes down.
all right,
It's trading up on news, and
agreed,
the news
agreed,
matters much less than people think it does. So
agreed.
near term, I would love to see the oil price back below 60.
Yeah.
But I think the oil price needs to be at a minimum 70. The oil market doesn't care what I think the price should be, first of all. So
Hmm.
that's an opinion as opposed to a fundamental.
Hmm.
And markets don't go to their equilibrium, they overshoot both ways.
Hmm.
What's more important to me is that the consequence of systemic underinvestment in sustaining capital and a hiatus in new capital. I mean, nobody other than Exxon is making big project investments,
Hmm.
not sustaining capital, but new capital. The consequence of that is that three years from now, it is almost certain that the current production surplus, which hangs over the market, becomes a deficit.
Yeah.
You will remember, Andy, the collapse in oil prices that we saw early on in the COVID time
Hmm.
when demand for transportation fuel fell apart. And the oil quote declined from 90, 92 all the way to zero
Yeah.
before recovering at $20. At $20, it was pretty clear that within 2.5 or 3 years, either the oil price went above 60 or your car wouldn't start. Those were the only two choices.
Hmm.
And the consequence of 2 years of systemic underinvestment in COVID times meant that the oil price didn't recover to 60, which is what it had to do. It recovered to 85.
This section contains one of the most underrated pieces of investing wisdom in the entire interview. Rick's point about CEO fanaticism is the fastest possible filter for identifying companies worth owning. A CEO who can't stop talking about their company, who gives you their personal cell phone without being asked, is operating from a fundamentally different motivational base than a professional manager who views the role as a stepping stone. The fanaticism itself is signal, and the inverse is equally powerful. A CEO who wants to talk about golf or the Super Bowl is telling you they are running a company, not building a business. Andy's track record, Integra, Luca Mining, Contango Ore, Aora Royalties, Revival Gold, from meeting CEOs at the conference, is the concrete proof of concept.